Well, welcome. Thanks for joining us this afternoon on a very windy day in Southwest Virginia. So glad to have everybody in our session today. If this is your first time joining the New Knowledge program, where have you been for the last 10 years? But this is a professional development program that was developed in 2014 to support the Washington County Business Challenge, and it's kind of grown, and we've continued these bi-weekly sessions to help our small businesses and organizations throughout not only Washington County, but now we're going throughout Virginia and other parts of the country. So thanks for joining us today. This program is a partnership with the Washington County Chamber of Commerce, the Virginia Highlands Small Business Incubator, and the town of Abington, as well as Virginia Community Capital. And my name is Sandy Ratliff, and I'm with Virginia Community Capital. Before I turn it over to my co-host today, I just wanted to let you know that today's session is being recorded for training and educational purposes. And to keep the workshop flowing, we do have everyone muted and your video off. However, this is a session and a learning opportunity, so we would encourage you, if you have a question for our presenter today, if you will post those in the Q&A section. We will address those during and especially afterwards, so I hope that you will give our speaker today lots of questions. Also, this session will be uploaded to the Virginia Highlands Small Business Incubator's Facebook page, and also our New Knowledge channel on YouTube. Just go to youtube.com/new knowledge, and you'll find probably 220 workshops that we've done in the past 10 years. So if you can't, if you're some other kind of training that you want, there's a good chance that it's in our archive, and you can find those on the Incubator's Facebook page and our YouTube channel. It's my pleasure to turn over the session to Kathy Lowe, who's the Executive Director of Virginia Highlands Small Business Incubator. And Kathy is going to introduce our speaker today. Thanks, Kathy.
Thank you, Sandy. So our presenter today is Mandy Wakem, Wakem Tax and Bookkeeping. Mandy was a tenant at the incubator for a brief time, and we enjoyed having her knowledge on hand in the building because we needed to ask questions on a regular basis. She is a QuickBooks expert, and without further ado, I'm going to give you to Mandy Wakem, who, by the way, is taking new clients if you are looking for a bookkeeper. So, Mandy.
Thank you, Kathy and Sandy. Okay, I'm going to share my presentation. Okay, so my business, as was stated, is Wakem Tax and Accounting. I do have a master's in accountancy from Western Carolina. I have been a tax professional since 2010 and became an enrolled agent in 2017. A little bit about our profession: you can be an enrolled agent, which allows you to practice in front of the IRS, handle notices, assist with audits with an IRS agent. The services that I provide for my firm is primarily tax preparation for businesses, individuals, estates, and trusts. I also, in conjunction with those returns, help small businesses with payroll services, bookkeeping services, sales tax services, and some general planning to help with tax liabilities, helping clients make sure that they have enough paid in throughout the year. There is other kinds of bookkeeping and tax, like nonprofit and governmental. Those are not my specialties, but there is some great resources out there if that is something that you want to learn more about. Get the slide. Okay, so I'm going to start off with business structures, some of the ways that you can set up your business and have a legal entity as a business. You can be a sole proprietor or self-employed. You do not require an EIN, an employer identification number, which is something the IRS issues. You do not need any sort of legal business structure either. This usually is reported on your individual tax return. You can go one step further, which would be a single member LLC. This is a legal entity which you file with the Secretary of State. You still can file this as part of your individual tax return, but this just allows you a little bit of legal separation from you, and you can request an employer identification number, an EIN, from the IRS, which will help protect your Social Security number in business transactions. If you have more than one member of your LLC, you can be a partnership. And you can also elect to be a corporation. There are different legal protections when it comes to each one of these. That is outside of my scope of practice. And so if you are interested in becoming a separate legal entity, I would recommend that you reach out to an attorney who specializes in business structure and setups, and they can advise you as to which one is best for your practice, your industry. Outside of legal structures, which are the single member LLCs, the partnerships, the corporations, and a multi-member LLC, there is a tax status, which lots of people are aware of, and it's called an S Corp, a subchapter S Corp. This is not a legal entity. You would have to be one of the other LLC, partnership, or corporation entities, and then you ask the IRS to tax you as an S corporation. And later I will discuss some of the reasons why or why not you would want the IRS to treat you as an S corporation. Okay. So we're going to move on to bookkeeping practices, some good ideas and tips. And this will go for however you set up your business. So from sole proprietor, self-employed, all the way up to, a corporation. You do want separate bank accounts for all of your activities. This is because during a review or audit with the IRS, if you commingle your business and personal income or expenses, it can make it difficult for the IRS to determine which one is business and which one is personal, and can cause you a lot more tax liability than you would or you should pay. So that is definitely the first thing I tell clients is get a separate bank account. Even if it's a sole proprietorship or a self-employment activity, have a separate personal bank account that only has income and deductions related to your business. And when you need to withdraw any of the income from that account, just transfer it to your personal general account. With self-employed or sole proprietor businesses, they do not require financial statements, meaning you don't have to have a balance sheet, cash flow statements, anything like that. So you are able to use a simpler tracking system like a QuickBooks Self-Employed, which I believe is about $5 a month from QuickBooks, and it'll help you keep track of all the normal deductions plus mileage. It will also help calculate any self-employment tax, which I'll go over to in a little while, and be able to print you out a worksheet that you can use to fill out your personal tax return. you can kind of just carry those numbers over from the QuickBooks to the Schedule C, which is where you report business income. I also have clients that use Excel that just export their banking information from their online bank and categorize the expenses that way. Whatever works best for you. Then as you move up in the business world, when you are a partnership, an S Corp, a multi-member LLC, any of those entities, you are filing a separate business tax return, and you will need financial statements, including a balance sheet. A balance sheet is what reports your assets, liabilities, and equity. Those are important to have when completing those tax returns. There are several online offerings for accounting and desktop choices. QuickBooks is one of the most popular. It can be expensive depending on the subscription level to have online QuickBooks, and they are moving to a subscription-based choice for desktop. So even if you have desktop where you used to be able to buy it and then have a supported service for about 3 years, they are moving to a subscription with an annual fee for that. But there's also free or reduced ones. ZipBooks is one, Wave app is another. I have clients that use both of those. And so as long as you're able to get those financial statements and record all your transactions, they're all pretty good systems. Something I get asked a lot is about receipts. I, as a tax preparer, do not request receipts. I prefer the summaries from your financial softwares or your Excel spreadsheets, that sort of thing. However, you as a business operator do need to keep all of your receipts related to your business activities. The general audit period is 3 years. That is what the IRS is going to generally look at if they were to audit you. However, if there are substantial errors, they can request to go further back. And as we all have heard, the accepted practice is to keep those receipts, those tax returns, those financial statements for 7 years. And that's as far back as they can go, unless you have not filed tax returns, and then they can go back as far as they want. There is no statute of limitation for unfiled tax returns. Another topic that I receive a lot of questions about is 1099s and vendors, and I will go into a little bit more about what makes a 1099 contractor. But the filing is required by the business owner. The burden of filing them is on you. You will be the one who's penalized if you do not file them. And a lot of people don't get what's called a W-9, and a W-9 is a simple form. It's just asking your contractor for their name, address, their EIN or social security number, which will allow you at the end of the year to provide a 1099 non-employee compensation report showing the amount of money that you paid them throughout the year. So it's best practice to have that W-9 completed by your vendor before you make a payment to them. Sometimes it gets very difficult afterwards to make that W-9 appear from the vendor. Okay. So a little bit about accounting. There is cash basis accounting and accrual basis accounting. Those are the main two types of accounting that you would choose from.
Hey, Mandy.
Yeah.
Just 1 second. We have a question. And she said she was told by an accountant that she didn't have to save receipts if she put purchases on her credit card. And she explains that she has a cafe and has at least 4 receipts a day.
Okay. So, my experience is, and I guess I'm just, I would say on a cautious side, is to keep those receipts so you can document. I had a client who previously to coming with me, this is, I guess, a sort of a real world example, did not keep receipts, and some of the expenses in places where everyone shops every day, like a Target or a grocery store or something like that. They could not substantiate that it was business use as opposed to personal use. And so she was unable to take some of her deductions that were in fact business use. So it's always best to keep the receipt so you have supporting detail. An accepted practice, though, is to have them digitally. I'm not saying that you have to keep the paper form, but scanning them in, having a receipt capture program like QuickBooks online. I just recommend that because it's better safe that you have that information than not have that information. Okay. So cash basis accounting is when your income and expenses are recorded at the time that cash is exchanged. Sole proprietors, self-employed individuals, they generally use cash basis accounting. And then there are several industries that also use cash-based accounting. It just depends on how your business is structured and what the general practice of your industry is. There is additionally accrual-based accounting, which means that you record the income and expenses at the time the transaction occurs. One of these would be contract work or repair work where you may invoice a client and it may take them a moment to pay you. So you'll have accounts receivable, which is an account that holds the money that is owed to you, but you have not received. And then accounts payable, which is the account where you hold all the monies that you owe people and have not yet paid for. These are reported on the balance sheet that I was speaking about earlier, which is where your assets and liabilities and equity are. Generally, you decide on one or the other at the beginning of business, and then you maintain it throughout your business activity. The IRS does allow you to change the activity or the accounting, excuse me, once. It's generally a cumbersome process. So usually you want to make a determination and then stick with that throughout the year or throughout your activities. Okay, and as was mentioned in the summary, I just want to go through some expenses that sometimes get overlooked or not correctly documented and can make a substantial impact on your tax return. So the first one is travel expenses. So anytime you have to travel for business, if it is related to continuing education, if it is going to get office supplies, all those sorts of things you want to keep track of. Mileage is a big one. And the rates generally change on an annual basis, although in 2022, it did change halfway throughout the year. There was 58.5 cents for the first half of the year and 62.5 cents for the second half of the year, but generally that does not happen. It does require you to keep a timely mileage log. They want you to record the miles as you drive them, and you can pick up a book from like Office Depot or Staples, Amazon.com, those sorts of services. And then within the last few years, there have been a lot of apps that are able to track your mileage and then provide you a report at the end of the year to give your tax preparer. I have been asked if there was any mileage apps that I personally have liked in the past, and they all have pros and cons. So whatever one works best for you, I would recommend. And then and then QuickBooks also has an integrated one. So if you do decide to go with QuickBooks, then you will have that integrated software. Then you have meals that you're allowed to deduct. Traditionally, again, it has been a 50% deduction. The last couple of years during the COVID period, they did allow 100% deduction on meal expenses.
Hey, Mandy, this is a good question and one that I've advised people on a regular basis. When tracking mileage, do you only track your to trip from home to work or to and from, so home to work? I'm interested to hear that because I was always under the impression that to and from work is not deductible.
Most of the time, yes. In the case of like you, Kathy, your mileage from home to work is not deductible. It is from your office space out. So if you are at your office and you go to Staples, you can deduct that mileage. If you are at your office and you have a second office, you can deduct those miles. Whereas I work remotely from my home, I can take mileage from my home to Staples or my home to a client's. But the mileage between your home and your workspace is considered commuting and is not deductible as an expense. If you travel, I have quite a few clients that travel to Atlanta sometimes for continuing education. That trip from your home to that space that you go to continue education is also deductible. So meal expenses, they must be business related. Is there another question, Kathy?
Yeah, I'm sorry.
Okay. No, you're fine.
She said, so she's sorry she was asking from a hybrid work schedule. They're in the office 3 days a week and at home 2 days a week.
I would still say in that situation, your primary office is the office space. And so it would not be deductible between home and business.
Yeah.
Yeah, that would be my thought on that. It's kind of, especially in the COVID era where this is becoming more and more popular, the hybrid workspaces and the working from home and stuff like that. The IRS hasn't necessarily come up to answer all of these questions specifically, so we can go back to what they've traditionally done, which is traveling from home to a workspace is not deductible.
So basically, if your company is providing an office, but they're letting you work from home, your home is not considered an office. And so driving from your home to your office is not deductible. Okay. So the next question is, if you're audited and you owe money to the IRS, can you set up a payment plan?
Yes. Okay. Yes. With a individual return, it's generally filed with the return, although you can file it separately. It's called an installment arrangement. I believe it's a Form 9465. And you'll go through a worksheet and it'll tell you what the minimum payments per month are. And you can obviously increase that if you want to, and then file that. And they're generally pretty accepting. And that goes for the state as well.
Okay, thank you.
Okay, so the meal expenses do have to be business related, but they don't necessarily have to be out. If you have lunch ordered in order to keep your employees productive and working, that is also considered business related. But if it is meals that occur during travel, a business travel trip, then they're most likely considered a travel expense. And this helps so that you can get the 100% deduction as opposed to the 50% deduction. Phone and internet expenses. A lot of us are working from home, even if we have office spaces where we work primarily. And so you are allowed phone and internet expenses. The IRS's stance is we all have cell phones and we all have internet, and we're most likely going to have them with or without a business. So unless it's a dedicated internet and or cell phone space, then you would not be able to deduct 100%, but you would be able to determine on your own a reasonable allocation. I recommend to my clients that they memo this somewhere that you have said, okay, I believe 30% of my internet or phone use is business, and then you can get that deduction and the business can reimburse you for those expenses. Again, anything with stuff that might be in the gray area, the mileage, the businesses, or the business meals, the phone and internet or other allocations you make for expenses, best to have that documentation as to why you are taking that percentage. Okay. There is also home office expenses that you can deduct if your primary place of employment is at home. There are two methods to this. You can use simplified. It's $5 per square feet up to 300 square feet. This means you don't have to keep track of all your individual expenses like utilities, repairs, homeowner association fees, interest, mortgage interest, taxes, that sort of thing. They'll just, as long as it's an exclusive office space, we can't deduct spaces at the kitchen table or in a living room area. You can just do the simplified. And sometimes that does work out better for some clients. Otherwise, there's the regular method, which allows you to allocate a portion of your home to business use. You take the square footage of your office and divide that by the square footage of your entire home, and you get a percentage. And then you're allowed that percentage you're allowed to use mortgage interest, property taxes, utilities, repairs that you've made to the whole home, pest control, home warranties, that sort of thing, all become deductible portions for your business. Any of those possible maintenance or repairs done directly to the office space for the use of business is allowed a deduction for 100%.
Okay, two questions.
Yeah.
So if you own a cafe and you give your employees meals, are those meals deductible?
The cost of those materials to make the meals are, yes.
But not the menu price?
Not the menu price.
Okay, that was one question. The other question is, what if you have somebody that works for a company, but they work from home, let's say 2 out of 4 weeks? Can this home office expense be a deduction on your income tax?
It's possible. If you are a W-2 employee, it's not. If you have a business or self-employed, it's possible. If this is where your primary practice is at home, and you don't necessarily have to meet clients or anything like that at that space, but if you run your business out of your home, that most likely you will be able to have a home office deduction.
So the difference is if you are a W-2 employee, this home office expense really doesn't apply.
Correct. Most of these won't. A few years ago, they took away the employee unreimbursed expenses deduction. So like right now, none of these apply to W-2 employees. Okay. So if you do have an exclusive home office that is where you conduct main part of your business, it's best to keep track of all of those expenses that are related to your home. And then that will reduce the income from the business. You cannot use home office to take a loss on your business. It won't create a loss for you, but it will help reduce any income that you have. And it's another significant deduction for a lot of people. Another thing is education expenses. Any continuing education, whether it's online or in person, books, training materials, anything like that is deductible. Taxes and fees, in addition to those related to business startups, a lot of states, I know North Carolina off the top of my head is $125 to file with the Secretary of State for an LLC. I'm sure Virginia and Tennessee also have similar fees. If you have to pay tax to the town that you work in or run the business out of, those are deductible expenses, and we want to make sure we capture those. Supplies required to perform your job are deductible. And I usually point this out because I have a large client base of therapists. And a lot of them maybe art therapy or play therapy. And so those materials, such as puzzles and toys and other art supplies and stuff like that, are deductible. So I want to make sure that you're aware anything that is ordinary and necessary for you to perform your job and your business activities can be deducted. Ordinary and necessary is something that the IRS uses. That's their language to determine, to explain what deductions are available for you. And then another one is retirement contributions. This is a planning item, something that you want to think of to help reduce your taxable income from the business. And usually you work with a tax preparer and or a financial advisor to figure out what makes the most sense for you when it comes to that. Okay, so I'm going to touch on payroll items. Not every business is going to have payroll. If you are self-employed or sole proprietor, you don't have payroll, most likely. And then if you're a single member LLC, you most likely do not have payroll. If you are a partnership, you may. If you're a corporation, you may. And then if you're in the U.S. to be taxed as an S corporation, you will. And again, I'll touch on that a little bit more here shortly. So another common question when business owners have for me is what makes a W-2 versus a 1099 contractor? So a W-2, most of us are familiar with. You work for an employer, they run your payroll, they withhold the taxes and then submit them to the IRS and the state on your behalf. When you are looking at what you have as far as workers, a W-2 employee, you have control over how and when they work. You provide them the space and the tools for that work to be performed. You provide benefits like paid time off, vacations, retirement, insurance, those sorts of things. A 1099 contractor is independent. They have control over when and how they do it. They supply their own equipment and tools to prepare and perform the job. And they also are serviceable to other clients. They have other clients and not just you.
Okay. This is a question that I actually just had a phone call about.
Okay.
So someone owns a business, they control your schedule, they do all your scheduling, they do not provide benefits, but they do provide the space and the tools, and collect your money and pay you a commission. But they give you a 1099. They don't pay your self-employment tax. However, they do control all of your other work schedules.
The IRS in the last few years has come down on businesses for this. I had another client who was treated as a 1099 person, and they were out of California, and the business determined, even though they had a little bit of control over how they perform the work, the company had control over the platform and what when they were to teach it and what they were to teach, and ended up reclassifying everyone as a W-2 employee. I probably would like to know a little bit more about that situation, specifics, but I almost think that they probably would be considered a W-2 employee by the IRS, based on that information.
Yeah. So, and I agree with you, but if they agree to pay their self-employment tax, which is what the problem is, with whether, so if they agree to pay the self-employment tax, would you give them a 1099 because of that, and let them know how much money they had collected at your place of business?
Are you talking about if the employer agreed
if the
to
employee agrees to pay their own, it's the 941 tax, right? 940 and 941 tax.
So the 941, and I'll just, we're going to cover that in just a second, but the 941 is what employers use to report and remit the federal withholding, the Social Security, and the Medicare on their employees. Self-employment tax is similar in that it is Social Security and Medicare tax for the self-employed. So it's the same percentage and the same tax. It's just it's differently named. If you are a 1099 contractor and you have income, it's going to be subject to self-employment tax. So it's really not an employer thing. But what the IRS believes is that employers try to avoid having to collect and remit these taxes and have that employee liability, and try to make people contractors when they may not really be contractors.
Okay.
So even that person is going to pay self-employment tax, I guess is what I'm trying to say. It's not really an agreement whether or not she's going to or they're going to. If they have income, they are going to on their personal tax return.
Right.
Yeah.
But as far as workman's compensation, and I may be getting out of the line here, but as far as workman's compensation is concerned, you, the employer, would still have to pay workman's comp on somebody that's drawn a 1099, right?
Correct.
Okay.
It's outside of my scope, but yes, I've done enough help with clients' workers' comps audits that yes, if you have a contractor, a 1099 contractor, you probably will still pay workers' comp insurance in some manner on that.
Okay, I don't want to get too far in the weeds.
That's okay. So there is risk if you mislabel or misclassify employees versus contractors. So it would be good at the beginning to really understand the difference between the two and make sure that the people on are classified correctly. It gets expensive and messy if the IRS determines that you have them incorrectly categorized. As I briefly said, I'll go over some of the payroll reports. You do have federal filings. The 941 is the form. that reports and remits your federal withholding for all your employees and the FICA taxes, which again are Social Security and Medicare. The deposits or the payments that are due can vary to semi-weekly, monthly, or quarterly, depending on your tax liability. It's important to pay attention to those liability thresholds because, again, can be very expensive if they're misdeposited. If you do owe more than $2,500 a quarter, the IRS does require you to have an online payment account with a website called EFTPS. And it's good to have that set up right away because it does take about 7 to 10 days for you to get approval and a PIN number and all that sorts of stuff. And the forms themselves that reconcile these deposits are due quarterly. You also have the federal 940 report and deposit. This is for your federal unemployment. Generally, small employers, small businesses only have an annual reporting and deposit requirement. If your annual liability exceeds $500, you may have to deposit more frequently. The report, though, is still due annually. And then, of course, W-3s and W-2s reporting all the annual figures are due to be filed once a year by January 31st to the Social Security Administration. In addition to federal, you have state reporting. You have federal withholding of your employees' wages. You do need an account with the Department of Revenue. And the frequency of those deposits in the forms depend, again, on your liability. Every state has a different threshold, but most of them are either monthly or quarterly. And then you have state unemployment. It also requires an account to be established with the Employment Commission of the state. Generally, they are deposits and forms that are filed quarterly. It's important to note that while the federal unemployment generally stays the same from year to year, the state unemployment generally changes every single year, and they will issue you new rates depending on your risk of having to pay unemployment. Okay, so I mentioned S corporations as to why you would want to be an S corp, why you would want to ask the IRS to tax you as an S corp. And I'm going to jump ahead to another slide here. So the reason why you would want to is for saving on self-employment tax. Again, know that self-employment tax is something that sole proprietors and self-employed single member LLCs pay on your personal return, and FICA is what is withheld and remitted on a employee, a W-2 employee. So they are the same thing. They are 15.3%, as I have here in my worksheet. So in the column here, if your business activity had net income of $20,000, your self-employment tax on that would be $3,060. And then if you had a net income of $100,000, your self-employment tax would be $15,300. Self-employment tax just also is different than ordinary income tax. So this self-employment tax is in addition to your ordinary income tax. And so the reason why you would want to ask to be an S corporation is to limit how much self-employment tax you pay. So this second part of this graph is showing an example about if you were to be an S corporation and you took salary, which is a requirement of the S corporation, your salary would be the portion that would be subject to self-employment tax. So again, in this first scenario, if you had $20,000 of net income, you would pay yourself a reasonable salary. In this example, it's $12,000. Reasonable is a gray area, and we'll talk about that a little bit too. But In an S Corp situation, your salary is what's going to be taxed on the FICA, the 15.3%. And so you have a reduction to $1,836 of self-employment / FICA taxes. Again, in the larger example, you go down and have it reduced by to $9,100. So I'm going to go back a couple slides again. So people ask, at what point does it make sense to be an S Corp? And there's no perfect answer to this. Everyone's tax situation is a little bit different. But if you generally have more than $20,000, $25,000 worth of income, and that is going to be a common level going forward, it's really good to work with your tax preparer to determine if an S Corp status makes sense for you to help limit that self-employment tax. Once you establish as a business entity, can send in a form 2553 to ask the IRS to tax you as an S corporation. With that, you as a shareholder employee or shareholder owner, you do have to take payroll. And that is one thing that some people choose not to become an S Corp for because they do not want to worry about filing payroll quarterly, monthly, whatever it is for your liability. But you are required to take salary before any distributions can come out. Distributions is money that the company has made, income that the company has made that you take out of the company outside of payroll, outside of having to pay that 15.3% FICA tax, which is where the savings is. So as I mentioned, S Corp owners are required to pay themselves a reasonable salary, reasonable being the IRS terminology again. Again, it's a little bit of a gray area, but there are some factors to consider. Your industry standards, the profitability of the business, the time that you devote, the skills that you devote to the business. And again, you can talk to your tax professional to work what reasonable means for you. And again, the S Corp status allows shareholders to limit that 15.3% FICA tax to only their salary. And then another benefit for being an S Corp or a corporation is you're allowed to include your health insurance on your W-2, which will allow you to deduct 100% of it as long as you have income from the business, as opposed to generally where it goes on the Schedule A itemized deductions, and many of us miss out on those deductions. So a benefit of being an S Corp is you do get those. But I also want to say that any business activity can deduct the health insurance. So
just to clarify, so if you become an S Corp, you take a salary, but then you take a shareholder's
distribution.
Is that taxed like dividends and interest? Is it taxed like short-term capital gains?
No, it is taxed as ordinary income. So if I look at this example here, the bigger numbers just help better. So in this scenario, you have $100,000 of net income before salary, and we are going to tax only 60% or $60,000 of that $100,000. So we have, you still have theoretically $40,000 worth of cash in the bank, income from the business, and you are able to distribute that money to you, avoiding the 15.3% FICA taxes, but it's still considered income from the business and is taxed at ordinary income rates on your personal tax return. So it's not capital gains or dividends or interest. It is ordinary income.
See, it just avoids the self-employment tax.
Correct.
Okay, thank you.
Yep. So that I covered a very broad amount of stuff. And if there's any questions or anything, I can answer more in depth. I can do that.
Speak now or forever hold your peace.
Do you have a slide with your contact information?
Yes.
No, there you go. Great.
There you go. I also have I've added a Calendly service, so anyone can go on and make an appointment using that link there if they want further consultation. And I do do like one-on-one half-hour consultations at no charge if someone wants to get a little bit more information or I didn't answer all of the questions here in this meeting, because there's a lot to it and I went over it quickly and broadly.
Hey, Mandy, and first of all, if anybody's got any more questions, please put those in the Q&A. But I have a couple of questions, if you don't mind.
Yeah.
What is the most common mistake that people do when keeping their books, or worse yet, their taxes?
So definitely the worst that I see when it comes to business-related activities is that commingling of money. That they don't separate their business activity. And I didn't really specify this, but this goes for rental activities too. If you rent out Airbnbs or you rent out long-term rentals, that separation of business activity and personal is huge, especially in an audit or a review.
Great. And as my business grows, there's probably going to be at a point where, okay, I can't handle it all. I can't do this. I've got, I'm adding employees and doing a second location. So when is the time that as a small business, you should really look at contracting it out, that service? And if so, what should I look for in a business or service to do that?
With everyone, it's a little bit different as to what point. What I tell people is the level of comfortability. I have clients that get it and they understand it and they just want me to oversee stuff and just double check them. And I have others that can acknowledge they don't know anything and they need help from the beginning. So I don't know. I guess at the point you start feeling overwhelmed or unable to understand what's going on in your business would be good. And the earlier, the better. As far as when you pick a professional, it's always best to have some credentialing, whether it's the IRS enrolled agency or a CPA, certified public accountant that is certified by the state. Also, someone who can help provide a large range of services, and not just tax preparation. So I always tell clients it's best, to have the same person prepare your business information as your personal information, because we can provide you the best consultation as to what will help you if we have all the pieces.
So Mandy, one last question. I think this lady says, how do I handle employee tips if I don't pay them waitress wage? Do you mean minimum wage? Question the person that's asking the question. Do you mean minimum wage, or what do you mean by waitress wage?
And while she's hopefully answering that, if an employer decides and they're hiring someone to help them keep their books, is there any security protocols that you should do in protecting you as the business should that relationship something happen and you need to terminate that employee? What some things that you need to do real quick
as an employee of your business, as opposed to hiring an independent?
Yeah, as an employee.
Okay. Passwords are big, limiting what portion of your business they can see. auditing will teach you that you should have separation of roles. Not one person, if it can be avoided, should be able to do all parts of your accounting. There should be one who does receivables, one that does payables, one who makes deposits, one who reconciles the banks, if possible. And then, be cautious about who you share passwords with. And when they leave, change all of your passwords.
Okay, so this lady clarified she doesn't pay waitress wage. She pays a minimum wage, but her employees collect tips. Mm-hmm. So how does she handle that?
I myself don't do a lot of tips. So I am cautious about answering that, but there are several forms that the IRS requires you in reporting those. And then you would want to work with a payroll provider to make sure that you have them classified, whether they're cash tips or charge tips, in that arena. But I myself do not have a lot of experience with tip wages. So I'm cautious about answering that question.
So this gentleman says that he's a real estate agent, but he's getting ready to get his license as a soil classifier so that he can issue septic permits. Should he keep these two services separate under the same LLC, or can he put them under the same umbrella? Will this be a red flag for the IRS?
And this is a common question. With those two, they can kind of be under the same umbrella, so I don't think there's anything wrong in combining those under one LLC. What I do tell my clients is try to avoid commingling things where liability of one business can affect the other business. I'm trying to think of an example for this situation. I have a client who does business consulting, and she is a mental health counselor, and she was wondering if she could combine those two things. And my advice would be not to combine those two things, because the liability of her doing business consulting and or the mental health profession could cross over and affect her business of the other activity. So again, outside of my scope, but there's some protections if you separate those business activities. From a tax point of view, those two are related. The other thing that I mentioned is you may have an activity that's profitable and the other activity may not be as profitable. So you may want to keep those separate so that you can see that on a financial statement.
So let me answer what I was told I had a service business for 30 years and had several hairdressers that worked for me. If we collected the tips on a credit card, then I was supposed to tax those tips at their employment tax rate. Mm-hmm. I was also supposed to ask them on a weekly or biweekly or monthly schedule to report their cash tips so that I could pay the taxes. That is beneficial to the employee because if they have to claim their taxes on their W-2, on their tax return on their own, they pay their own self-employment tax. If the employer reports their tips, then the employer is liable for half of their employment tax. Correct? That's what I was told when I was.
And that feeds, FICA taxes. That helps support you later on in Social Security benefits and stuff like that too.
Okay.
Which I have gotten a few questions about that too. When you are self-employed, that self-employment tax is Social Security and Medicare. So you are paying into the system even though you're not a W-2. And I've had that pop up a couple times lately. So you are paying into the same system even though you're self-employed.
Yeah. Well, Mandy, thank you so much. This has been very helpful, I know, for folks. And, I'm just sitting here thinking about the presentation and how it would be helpful for the business challenge participants. So we may have to recruit you to be a panelist in the Ask the Expert, because I really think this has been very helpful for folks who maybe are less than 5 years into a business. I appreciate your efforts to help us today. And folks, if you have any questions, Sandy's going to present. Sandy can send this whole PowerPoint out. So let Sandy know. And Mandy, thank you. And I hope you have a good rest of your day.
Thank
And
you.
Mandy, I wanted to say thank you too. We couldn't do this series without professionals like yourself, and I know I learned a whole lot, but I appreciate it. And just wanted to give everybody a plug to let you know that our next session is on May the 17th, and that will be on succession planning, and will be led by Whitney Pennington with Pennington Law Firm. And if you don't have a will or operating agreement for your business and other important personal and business documents, I highly recommend that you join us in 2 weeks for our next session. Also, I wanted to give you a heads up that we have a new series of new knowledge sessions starting in July through December, and those will all be focused on different tools and services offered by Google that are mostly all free. And as a small business or nonprofit, the ability to utilize these products to effectively operate your business and organization are, I think, is valuable too. So I hope you can join us for that. And just a reminder, today's session will be on the Virginia Highlands Small Business Incubator's Facebook page in a couple of hours, and it'll also be on our new knowledge channel on YouTube. So thanks again for joining us, and I hope you can continue joining us throughout. And I see, that's it. No other questions. Thanks again, everybody. Have a blessed day.
Thank you.
Take care.
Bye-bye.
Bye-bye.